Good morning and welcome to another live technical analysis. We're going to be starting off with the euro against the US dollar. So, ECB Vice President De Guindos indicated that the current interest rate levels may need to remain at their current levels for a prolonged period of time. So, having spoken earlier on today, it appears that it may have been slightly hawkish. For the day, we're seeing the pair remaining relatively unchanged. Yesterday, it appears that the dollar strengthened. But if we move on to a more overall time frame, we can find the US dollar index that we have. The new one, it's H4, if I'm not mistaken. Yes, here we go. Templates. And now on the daily, we can see that the dollar was slightly gaining against its counterparts yesterday. So it may have been some sort of relative strength for the US dollar. On a weekly time frame, however, you can see it is moving in a downwards fashion. Now, this could be attributed to a technical or also a fundamental point of view. Now, the market anticipation for six rate cuts for next year by the Fed remains, but we've been seeing many Fed officials push back at that speculation. Essentially, they're telling them that they may be overreacting and they may be getting ahead of themselves. But for now, it appears that that is the predominant market theory. Back to the euro against the US dollar. As you can see, it is moving in a slightly sideways fashion. It has broken below our upwards moving trend line. The narrowing of the Bollinger Bands in combination with the RSI indicator below our chart appear to facilitate a sideways motion. Now, in terms of indicators, we can open the volumes as well. We can see slightly lower volume. Now, based on the fact that next week we have Christmas and essentially we're entering the holiday season, essentially we expect there to be perhaps high volatility. In what sense? Well, since we're anticipating that the majority of market participants will be taking some time off, there is the possibility that we may see heightened volatility. As, for example, let's say traders during the European session were pushing the euro up, then perhaps traders during the American session push it slightly lower. We may see pairs moving in a particular direction if there is a lack of interest from the other side. So we would note that as well. In terms of the euro, we're maintaining our sideways bias for the pair. We can start to actually draw or place a sideways channel, but it has been validated again. There's only one touch and it has not come back down. So we could actually smooth this. Now we're going to be keeping our support and resistance levels the same as we had placed yesterday. So S1 at 1.0915, S2 at 1.0825, S3 1.0725. In terms of financial releases, we're noting the final GDP rate for the US, which is going to be coming out later on today, and that rate is for Q3. Now, the GDP rate is expected to increase from last quarter, but given that this is the final rate, there is a possibility that the market expectation of an increase in GDP has already been priced into the market. So, what could change? Well, if surprisingly the final rate comes in lower than expected, we may see the US dollar weakening. Why? Well, a reduction in economic growth, or at least a particular, I'd say, slowdown, could weaken the US dollar, which could allow the euro, the British pound, and the Japanese yen to all gain against the US dollar and as well its counterparts. So, Australian dollar, we can see the dollar weakening, the Aussie moving higher. Dollar CAD, we can see the loonie gaining and moving lower, in particular the pair. We could see gold gaining as well. Now, if it comes in better than expected, but keep in mind this is the final rate. So we don't really see much deviation in the final rate in terms of comparing the preliminary release and the final. But if it does come in higher than expected, we could see the dollar gaining. In terms of technical analysis, however, the euro against the US dollar appears to be moving in a sideways fashion. As we said before, the Guindos could have been perceived as slightly hawkish, but appears to have had an immaterial effect on the particular pair. For the British pound against the US dollar, now we can also say that it's moving in a slightly sideways fashion. It's below 50, but it's not below 40. So what does this mean? Well, it may imply that there is a slight bearish tendencies moving towards S1. Staying between S1 and R1 could be a facilitation of the sideways fashion. Now you could see that this could also be the formation of a downwards moving trend line. But given that the Bollinger Bands appear to be moving in a slightly sideways fashion as well, we would also maintain a sideways bias for the pair if it fails to break below S1 at 1.2595. We could keep our resistance level as it was yesterday, 1.2720, R2 1.27, 1.2870, R3 1.2995, S2 1.2475, and S3 1.2300 for the dollar against the Japanese yen. Now, the bank remained on hold as was widely expected earlier on this week. So we're seeing that potential impact playing out, but it could be attributed, so yen strength could be attributed to dollar weakness rather than yen strengthening in itself, as we should remind that the bank remained on hold and their comments appear to be predominantly dovish. In terms of the US stock markets, looking at the S&P 500, now if we move on to the monthly, you can see that it created an all-time high. The all-time high figure, if we zoom on to this candle, could have been at the 4,000, well, 4,777 figure. So on a monthly time frame, you can see it broke above the all-time high. Now, in terms of indicators, we're noting lower volume. RSI is at 60, so implying a bullish market sentiment remaining. It's above 60, so it's not between 50 and 60. So there appear to be some bullish tendencies. Depending on how you trade, or perhaps how you'd like to see the market, you can move on to a 4-hour. If we move on to a 4-hour chart, you can see that it's broken below our upwards moving trend line, and as such could be due a market correction lower. Note how it's bounced off the lower band of the Bollinger Bands. As such, we could see a retracement back to the mid-range before seeing the index moving lower. But if it does come back up, perhaps it could move higher. Now we're going to be charting on the 4-hour and on the monthly time frame. So for the 4-hour, I would, for the first level of support, we could take where it bounced off the lower end of the Bollinger Band at 4,700, rounded up. Then for our S2, we could bring our S2 line to validate this old high, broke above and then moved higher. So at perhaps the 4,600 level. And then for S3, perhaps we could take it be too far away from S2. So I'd rather bring it slightly lower, validated by these 4 wicks. So bearish, bullish, doji, then bullish candle. Well, actually a bearish candle because it didn't actually wick down to S1. So 4,490, that would be S3. Now, in terms of the 4-hour, note how it's made a sharp drop and dropped below 50. Even if it is coming back up to the 50 RSI figure, I would expect it to maintain a bearish market sentiment due to the fact that this was a steep drop. Now, if it fails to break above the mid-range, I would maintain a bearish outlook for the S&P 500. However, in the event that it does break above the mid-range, sideways fashion between S1 and R1, and then we have R2, and then if we simply extrapolate the distance between R1 and R2, so 15,914, we would have R3, 5,110. Big figure as well. Let's just change this to red. Now, we're keeping our resistance levels further away than our support levels as we do not have any historical data. These potential resistance levels are assumptions. They have not been tested. As such, we would have to wait for the price action to move higher before actually seeing where there is resistance by the market. Now, for support, we do have historical data, and as such, we could place RST at 4,490. From a technical point of view, maintaining a bearish outlook if it manages to break below S1 and then potentially moving towards S2. If it fails to break below S1 and actually stays between S1 and R1, then we could see the beginning of a sideways fashion heading into next year. If it breaks above R1, then we would switch to a bullish outlook. Next potential target being R2, 4,958, which could be rounded up to 4,960. We move on to the weekly, well, actually the monthly. You can see that it's moved higher. It's created a new high, a higher low as well. And if we draw an upwards moving trend line from this swing low, you can see that it is still validated. Therefore, from a more macro perspective, you could maintain a bullish outlook for the S&P 500. Note that the RSI on the monthly chart as well is at 60, implying bullish market tendencies. Such, from a more macro perspective, you could be potentially long on the S&P 500, whereas from a shorter time frame, you could potentially short the S&P 500. In terms of gold, it appears to be validating our sideways fashion that we had, our sideways motion that we had anticipated between S1 and R1. I will not be changing the support or resistance levels as they continue to be validated. It appears that the sideways moving channel continues to hold. Narrowing of the Bollinger Bands between R1 and S1 appear to validate this hypothesis, in addition to the RSI indicator remaining near 55, implying a neutral market sentiment, and as such, I would maintain a sideways bias for the pair. Now, in terms of the Dow Jones 30, there appears to be a similar story, having broken below our upwards moving trend line, so maintaining a bearish outlook for the Dow Jones 30 index. It's broken below our support level of S1, so this could be potentially, well, not potentially, this could be support and resistance, could be validated now before price action moves lower. So you have R1. Let's just readjust, coinciding with the price action here, 37,295 for R1. Then for R2, 37,830. Then for R3, 38,350. Whereas for support, 36,770. S2, 36,225, 255. And then for S3, we'd have to look. So we have R1, R2, R3. And then for S3, we would take this previous high, coincides when this bullish candle broke above, opened and moved higher. Therefore, potentially a support level at 35,720. So this could be our S3. Changing this from red to green. But same story. It is the same story with the S&P 500, and I'm assuming that the Nasdaq might actually be the same, but we'll have to check. So maintaining a bearish outlook for two indexes out of the three so far. Same with the Nasdaq 100. Look how it's bounced off our support level at S1. For this particular index, we could simply bring our resistance level to this candle, 16,870. That could be our R1. 16,870. That could be our R1. We could keep S1. Well, we could keep the rest of the support and resistance levels the same. So this is slightly narrower, so the distance between S1 and R1. Given that the RSI also steeply dropped from 70 to 50, implying bearish tendencies, I would maintain a bearish bias for the Nasdaq 100 along with the S&P 500 and Dow Jones 30. So same story. If it manages to break below S1, maintaining our bearish outlook. If it fails to break below S1, sideways bias. Whereas if it manages to break above R1, then we could switch to a bullish outlook. Let's look at the weekly. On the weekly, it appears to be gaining all-time highs. Dow Jones 30 as well, all-time highs. So we have all three major indexes making all-time highs. How long that will last, that remains to be seen. Depends on whether you're looking at a more shorter time frame or at a longer time period. In terms of oil, now oil prices appear to be moving higher, which may be a surprise to some of you. In terms of when the US announced that it was creating a coalition to protect naval vessels in the Red Sea, I think it was this bearish candle here. As such, if you're protecting the shipping vessels, then that means there is less of a need for them to take the longer route to reach the markets. But it appears that concerns still remain, and as such, we would maintain our bullish outlook for crude oil, which is WTI cash, on a 4-hour time frame. We were keeping R1, R2, R3. Now, support we could actually bring slightly lower to reflect the most recent developments. So 73.75. Now, for oil prices, we could maintain from a fundamental point of view a bullish outlook if the Houthi rebels continue to threaten naval vessels or continue firing projectiles at essentially anything that comes near their coast. If they continue firing and then we have more warnings, then we could see oil prices continue moving higher. Whereas, should they stop, or if we see a de escalation in the region, it could potentially weigh on oil prices. But in terms of a technical point of view, RSI, upwards moving trendline, Bollinger Bands being tilted towards the upside, it temporarily broke below RS1 we had yesterday, but it could have been market correction, bounced off the mid range. We would maintain a bullish outlook for oil prices, with the next potential target for the bulls being R1 at 76.38, then R2 79.70, and then R3 82.57. Now, in terms of the dollar against the Japanese yen, which is also known for financial releases, we have the CPI rates, which are due to be released tomorrow and are anticipated to come in lower than last rate, the last rate that we had. Now, when the CPI rate comes in lower than expected, that could weaken the currency. But in terms of Japan, given their ultra loose monetary policy and their ambitions to reach 2% inflation, it could actually provide some support if the BOJ hints that they may potentially raise interest rates sooner than what is currently expected by the markets, which, if I'm not mistaken, is between March and April. The market's anticipating a potential rate hike of 0.1%. Now, if that changes or we see a more hawkish sentiment emerging from the BOJ, perhaps the Japanese yen could strengthen from a monetary policy perspective. However, based on what we've seen this week from BOJ officials, that does not appear to be on the cards just yet. Essentially, the BOJ is concerned that the market was running wild with anticipation that the bank was actually going to potentially hike in the meeting they had this week. So they've essentially calmed market expectations. So I would not expect any hawkish rhetoric emerging from the BOJ, at least not until next year. So for now, though, from a technical point of view, broken up below our upwards moving trend line. Now, if it fails to break below S1, sideways bias between S1 and R1, so 142.50, 144.40 for support and resistance. Whereas if it manages to break below S1, the next potential target for the bears could be S2 at 140.85. Moving on, we can see, well, we could look at the Australian dollar against the US dollar. Now, the Aussie appears to be moving in an upwards fashion. So it did break below our upwards moving trend line, but it didn't break below S1. So it bounced off 0.6725. So I'd maintain a sideways bias between S1 and R1, unless it manages to break above R1. If it breaks above R1, then we could potentially see a bullish momentum being forward for the Aussie. Whereas if it breaks below S1, then we would switch to a bearish outlook. But based on what we're seeing, it is possible that it may move in a sideways fashion between S1 and R1, at least for now. Dollar CAD. So the Canadian dollar is strengthening against the US dollar. Now, this could be attributed to two reasons. One, given that Canada is an oil producing nation, so an exporter as well, higher oil prices could support the loonie as well. Therefore, from one point of view, higher oil prices equal to stronger CAD, and the dollar weakness could be attributed to the Canadian dollar gaining against the US dollar. On a weekly point of view, it's on track to finish 2 weeks in the reds, so strengthening for the Canadian dollar against the US dollar. On the 4 hour time frame, we note that it's not moving significantly lower, but it is maintaining a downward trajectory. But this slight hesitation could be a support level. And if we're going to be placing that as a support level, that means we need to bring up S2 and S3. Because if you compare the distance between R1 and R2, and then you see S1 and S2, it's pretty significant. So for this particular pair, we can take an old sideways moving channel. So this used to be support, and as you can see, it was validated here. Let's just zoom in. Right around here, there was a support level. You take the wicks, moves in nicely. So this was a sideways moving fashion, managed to break above, moved higher. So this could be potential S2. Now for S3, we'd have to readjust our support level for S3 as well, perhaps slightly higher. But the distance between S1 and S2 is 166 pips, and then between 295. The beginning of this upwards moving trend line that we used to have. And let's just come back and let's fix our labels. So we have 1.3315, that would be S1. For S2, you could have 1.31314, well, 3150, simply rounding it up. 1.3150. For S3, you could have 1.2975. Then we could keep our resistance levels the same. So our one at 1.3405, our two 1.3535, and then our three 1.3710. For now, you could say that it may be moving in a sideways bias, but note that the S1 and R1 levels are fairly close to each other, and as such could be easily broken. And was rolling along the figure of 13, implying strong bearish market sentiment. This could be a market correction since it hasn't broken above the mid-range of the Bollinger Bands before continuing its descent. So for the Canadian dollar, okay, the loonie gaining against the US dollar. Dollar Turkish lira. Now we note that Turkey's interest rate decision is due to take place in approximately half an hour. So they're expected to increase their interest rates, but as we've said on numerous occasions, if it's not significant, then we might not really see a reaction by the markets, and as such, pairs against the Turkish lira, so euro Turkish lira, dollar Turkish lira, could continue on their ascent, which is forming all-time highs every single, well, yes, every single day. We're seeing potentially new all-time highs. Now, the 4 hour time frame is highly volatile, so we'd rather use the daily. In terms of the daily, technical analysis for the Turkish lira is quite difficult, but what we could do is we could take this bullish candle, and then extrapolate an upwards moving trend line, validate by these three candles, or we could take this wick. But essentially, it appears to be a bullish market sentiment for the dollar against the Turkish lira, so anticipation that the Turkish lira could potentially weaken. Now, even if I had drawn an upwards moving channel, note how close these candles are. But it could be a potential upwards moving channel. It appears to be so. But based on the Turkish Central Bank, this could easily change. It could be destroyed. It could wick down lower. Could, depending on what they do. Like if they hike by 150, no, they're expected to hike by approximately 250 basis points, if I'm not mistaken. But if they hike by much, much more, you never know. The price action could come back lower, could actually come back to 23. But it appears unlikely. Based on the market expectations, we may see the Turkish lira weakening further. Now, in terms of support and resistance, and before we add that, let's add the Bollinger Bands as well. Let's see what else we can have. We can add volume as well. Decreasing volume. Okay. And then indicators. Implies low market volatility, but I expect that to be up until the interest rate decision. So, as we said, for the Turkish lira, let's remove the indicator. We're seeing lower volume, so perhaps lower market participation, which could be why it's actually narrowing here. Move this. Now, for support and resistance, we're taking big swaths. So we have this bearish candle and bullish candle, $25, 25.70 if we round it up. Now it could be S1, then S2, and then S3 at the beginning of this upwards rally. Let's remove these old channels, these old trend lines as well. So as you can see, when it managed to break above, it continued on its ascent. Now, some of you may be wondering, why is my support level not closer to the current price action? Simply put, it could be easily destroyed within a few hours. And since we're talking about the Turkish lira, I'd rather keep my support level at a greater distance in order so that when it does come down, for it to be a bearish, it would have to break S1, moving towards S2, and then towards S3. The distance is 258 pips approximately between my support level S1 and S2. For resistance, it's purely hypothesis. So for resistance, we could put it at the 2920, let's say, or 29. Let's put 2950. We're going to be using big figures. So 2950 for R1. So this could be our first line of resistance. In terms of R2, we said 260 pips approximately. Then we could extrapolate 260 pips. Or we could try something else. We could go increments of about $3. So we could go with perhaps 3150. And then we could go 3450. This is purely speculation, and I actually like to have R3 at a greater distance than R2. Note that I'm actually doing the same for S1, S2, and then between S2 and S3, there's a bit of a larger distance than the support levels. The difference is with the Turkish lira, since it's very volatile and could easily move lower, we'd rather keep a greater distance for R3 just in case the first two levels are broken almost immediately. Now, even if they do hike and the Turkish lira does slightly gain, it could come back down to perhaps S1 and then recoup and move higher. But that depends to be seen. From a technical point of view, 77, above 70, so it could be slightly overbought and maybe due a market correction to lower ground. But that remains to be seen. We're going to be looking at Apple. We'll actually look at Tesla following a Reuters report that Tesla knew about defective items. Well, not defective items. They knew about certain structural problems in their cars, and then they tried to pass on their costs to their customers. Now, this was a report by Reuters that was released yesterday. This could, in theory, be weighing on the company's stock price. Now, the past 2 weeks, we've released our weekly equities report in which we've mentioned Tesla almost every week. This could be concerning for the company's stock price, and as such, we could attribute this bearish candle to a fundamental perspective or point of view. In terms of support and resistance, we could take the new price action, move up our support levels to this low, swing low, move higher, fail to break above. But based on that, its actually trajectory is moving towards 50. I wouldn't say sideways. I'd say more of a bearish if it breaks S1. If it fails to break S1, then I would switch to a sideways bias, whereas for a bullish outlook, I would like to see it breaking above R1 at 256.80. Now, given that we've actually adjusted our R1, that means we should adjust R2, and by default, adjusting R3 to this old high. So you have R1, R2, and R3, 277.66 for R2, 295 for R3, and then R1, 256.80. Now, for support, 230.07 for S1, then S2 could be 208.60, and then for S3, we could take this beginning of this bullish candle, so we could have 184.50. Let's just round these up as well. 208.60, then 230.10, just to make it easier. So I have S1, S2, S3. Now, from a more macro perspective, one could say that this is an upwards moving trend line. As you can see, validated by this wick, started from here, validated again, and is moving higher. But Note that the RSI is has rapidly moved towards 15, which could imply that the bears may be taking control over the company's stock price. For a shorter time period, I would maintain a bearish outlook for Tesla if it breaks below S1. If it does not, sideways bias between S1 and R1. We could also do Apple as well. Now, Apple appears to be moving in a downwards trajectory from a fundamental point of view as well. According to Reuters or the Financial Times, I'm not certain who reported it first. Apple has lost a patent case against Massimo, which is a medical device maker, in terms of the newer models. And then, according to that report, Apple has announced that they would not be selling their newer smartwatches in the US in particular, not worldwide, simply in the US. Now, this could be concerning for Apple, given that the Christmas holiday season could be considered one of the greatest spending, I'd say, periods of the year. So if you're not selling one of your products during a time where the majority of people are perhaps looking for gifts or spending or going out, you could lose out on a lot of revenue due to the loss of potential sales, which could weigh on the company's stock price, as appears to be the case currently. So from a fundamental point of view, I would maintain a bearish outlook on Apple if it breaks S1 today, and then potential target being S2. In terms of resistance, we could take this wick here, and we could slightly bring R2 to lower ground. Could adjust, zoom in. R2 to 107, 199.35 for R1. But from a fundamental point of view, we could maintain a bearish outlook on Apple. Breaking below S1. Next target potentially being S2, 187.15, and then S3, 181.25. So from a fundamental point of view and a technical, it appears to be maintaining a bearish outlook for Apple, as we've said numerous times, despite the Bollinger Bands being tilted towards the upside. There's a potential that the fundamentals may be taking over the company's stock price direction. And with that, I think we're going to be done for today. And if I'm not mistaken, we're also done for the remainder of this year. Happy holidays, and we'll see you at the beginning of 2024. Thank you for watching. Goodbye. Stay safe.
Everyone, the term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk on or risk off. Both of them express global market sentiment. Risk on, risk off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen, and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Started as per usual a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so maybe just a brief introduction. I am Melanie and I will be your speaker for today's stop loss strategy webinar. Okay, let's go ahead and get started. So here's our agenda for today. Firstly, we'll talk about how stop loss will affect your risk to reward ratio beyond and before. So if you're wondering what that is, we'll get into that in a little bit. And then how far should your stop loss be, market structure stop loss, Fibonacci stop loss, and then we'll go through a couple of trailing stop loss strategies as well. Okay, but first things first, we'll go through the anatomy of a trade as well as some risk management strategies. So trade management refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. So, of course, the anatomy of a trade contains or consists of the entry, your stop loss orders, as well as your stop profit or take profit orders. And then this is what is part of a risk management series, which we won't go through in detail today. Maybe in future webinars we'll go through these, but for today we're going to focus purely on stop loss, and we'll touch a little bit on trailing stop loss as well. Okay, so firstly, why is it so important to have a trade management strategy? So firstly is to control risk. Trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses as well as manage their overall risk exposure. Next, maximize profits. So trade management strategies such as take profit orders and trailing stops help traders to lock in your profits and maximize returns. manage emotions. This is pretty important because the discipline and structure that having a good risk management strategy provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So when you have a well-defined trade management plan, then you can make faster and more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly, increase consistency. So an effective trade management strategy and risk management techniques helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so let's get into it. So although we're focusing purely on stop losses for today, I do want to touch a little bit on take profit as well. So we'll start off by going through the issue of having a fixed take profit and stop loss. Okay, so we're going to start off with take profit. So let's take a look at this example together. So the red area here shows a strong resistance area because this has two multiple swing highs that line up nicely. So if our trading strategy requires us to have a fixed take profit of 100 pips, then we will place the target beyond this strong resistance area, which you can see here. That's what we did here. Okay, so let's see how this plays out. And you can see that price shot up, but it missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So it might not reach where you place your take profit. Okay, so here we see in an alternative scenario, if we had placed our take profit before the key resistance level, which means just slightly below, we would have got a profitable trade because price would have been nicely touching our take profit. So it's important to look at the charts and then adjust your take profit and stop loss accordingly. So the lesson that we're trying to talk about in this case is to not blindly follow a fixed take profit target just because some forum or education platform tells you to do so. Because you always want to look at your charts and adjust accordingly because each chart is different. Okay, so this is the general idea for stop loss and take profit placement. So this is what we meant earlier by beyond and before. So for a stop loss, we would typically recommend you to place it beyond a major resistance area. So if we're talking about a major support area, or this should be support instead of resistance. So if we're talking about a major support area or even a major confluence area using Fibonacci, you want to place your stop loss below it or beyond it. Below would be if it is a support level. And you can see in this case, since it's a resistance area, we'll place it above. So that's what we mean by beyond. So for our take profit, on the other hand, we want to make sure that we place it before. So that means that it's within the charts. So not beyond it, before it. And if we're talking about a major resistance area, then we will want our take profit to be placed just beneath it. Okay, so this is the general idea for a proper stop loss and take profit placement to ensure that you maximize your wins as well as minimize your losses. Okay, we'll go through a couple more examples in the next few slides as well. Okay, sorry about the mess over here, but this is just to recap a little bit about the whole stop loss beyond take profit before concept, but in the context of Fibonacci confluence. So in this case, we're talking about Fib confluence. So stop loss beyond still stays, and you want to place it beyond a key Fibonacci confluence area. So price is attracted to strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the most common reasons why people wonder why they got stopped out right when the market starts to reverse. So if we talk about take profit, we mentioned earlier we place it before a key Fibonacci confluence area or major resistance area, so on and so forth. And the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So this is one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so that's the general idea of trade management and where is the proper placement for stop loss as well as your take profit levels. Okay. Here in this case, we are talking about the problem with fixed stop loss. So earlier we talked about the problem with fixed take profit. So now we're talking about stop loss. So here's an example to show this problem. Here we have a support level. You can see two swing lows that line up nicely at this support level. Price has bounced off of this support level, and we are expecting it to continue to rise to the swing high resistance over here at the 1931.43. Okay, so our stop loss of 100 pips is fixed at this 1894.75 level at the support level. Okay, so this is what happens instead. Instead of shooting up as we expected it to, it actually reversed off of our entry and then bounced off perfectly. So what we should have done instead was to place our stop loss, which was over here, the green line. Instead of the green line, we should have placed it at the yellow line instead, because we mentioned earlier that you want to place your stop loss slightly beyond a key level of support or resistance, just to allow that space for a reversal or a bounce to take place. Okay, and we can expect this to happen because price often gets attracted to key levels of support or resistance and then reverses off of them. Okay, so now we're going to talk a bit about dynamic stop loss placement. So that's what we talked about in the previous few slides, is precisely why dynamic stop loss placement is so important. So if you're wondering what exactly is a dynamic stop loss, it's a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. So the goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. So here is our first example. It's to demonstrate dynamic stop loss. Here we have price bouncing nicely off of the support level at 86.721. So it's bouncing off here. We're expecting it to reverse off the entry at this 87.819. That's in line with this 100% Fibonacci projection level. Okay, and then our stop loss is placed at this swing high resistance here. So this is what happens. We're expecting it to reverse off. So it does test this level, this entry level. And the reason for this, for that bit of resistance, extra resistance at the entry, is because you can see earlier we have this 100% Fibonacci projection that lines up nicely with this level. So you can see the resistance and price testing this entry. Next, we have the negative 27.2% Fibonacci expansion, as well as the 61.8 Fibonacci projection that line up nicely. So this is where we decided to place our stop loss. And this is how we used Fibonacci levels as stop losses as well. When you have a couple of levels that line up nicely, we call that a confluence area. And it's even better if you can find a chart indicator, market structure indicator, where basically you look at the chart and you see that, oh, this is a resistance level, and we place a stop loss here. And this stop loss lines up nicely with Fibonacci levels as well, which makes it extra important to take note of. So we see price is testing the 87.819 level at the entry here. So we mentioned earlier that stop loss should be placed beyond the Fibonacci confluence area instead of directly on the area. And we'll show you why in the next slide. So this is a zoomed out version of what we had in the previous slide, but you can see price breaks out of our entry and it hits right towards our stop loss levels. And it's just as we had expected, because this is, as we mentioned earlier, that this area is an important area with the Fibonacci confluence as well as the swing high resistance. So this whole area is a strong area, and its price is attracted to such strong areas of resistance. So we can expect price to be attracted to this area. So what we do is we place our stop loss beyond it. And you can see if I place my stop loss directly on this Fibonacci area instead of beyond it, we would have gotten stopped out. So we're expecting the reversal, and it hits right down to our take profit, which is exactly what it did here. Okay, let me know in the chat if there are any questions throughout the webinar. But I think so far we should be pretty clear on this. So let's take a look at another example. In this case, we have another take profit placement example. So here we're expecting price to bounce off of our entry at the 87.625 level at the pullback. So this is what we call a pullback resistance, because we have a swing low here and price has passed this area here. So before price actually reverses off this area, it's called a pullback, because we are expecting price to pull back to that level or retrace to that level. Okay, so our stop loss is placed at the swing high resistance here, and our take profit is placed at the swing low resistance. And then if we take a look at our Fibonacci, we have the 78.6% Fibonacci retracement that lines up nicely with our entry level. So once again, this is a level for us to take note of. We can expect price to be attracted to this level here. Okay, you can see price moving up this area. Price hit our entry and has reversed off of it nicely. It's now heading towards our take profit. And then we pull out another Fibonacci indicator. In this case, we are using Fibonacci retracement. Okay, this is wrong. It should be 50 Fibonacci projection, because this is our starting point, our middle point, and our ending point. So this is a 78.6% Fibonacci projection. Sorry about that. But the chart is still correct. We have a projection level that lines up nicely with our take profit. So you can see we're expecting price to be attracted to this area because of the swing low resistance, swing low support, as well as this Fibonacci level. So you can see price was attracted to this area. It approached it continued downwards to our take profit, and it touched our take profit just nicely before reversing off of it. So this is one reason why we advise you to place your take profit before it, because if you had placed it even slightly below, you would not have caught this take profit there. Okay, actually even this take profit level is a little bit far, so you have placed it further in on our price chart. Okay, next example, we're looking at a take profit placement again. So even though this is stop loss, but we want to talk about take profit to show you guys how the two line up nicely together. Because even if you have mastered all of the stop loss strategies, if you can't manage to get your trade in a take profit, there's no point to it basically. So here we have firstly a descending trend line, but you can see our price has recently broken out of this descending trend line. So it's giving us a bullish bias. Okay, so after we've established that, we go in with our take profit and stop loss levels. And these we make use of the support and resistance levels here. So our entry is at this pretty significant level, overlap resistance. Overlap just basically means that a bunch of swing lows also line up nicely with a bunch of swing highs, and price has tested this level many times. Then our stop loss level is just at the swing low here, and our take profit is in line with many Fibonacci levels that you can see here. So it's a negative 27.2% Fibonacci expansion, as well as a 127.2% Fibonacci extension. So with these two lining up at our take profit level, remember you want to place your take profit before instead of beyond your Fibonacci levels. Okay, in this case, you see we place it above or before it, or beyond it, I mean. And you can see price reversed off of it and we missed our take profit by a few pips. So if we had placed it below instead, it would have nicely hit our take profit before reversing back down to our entry. Okay, so now let's get into the trailing stop loss. So a trailing stop loss is a special type of trade order that moves relative to price fluctuations. So when the price goes up, it will drag the trailing stop loss along with it, but when the price stops going up, the stop loss price remains at the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as long as the trade moves favorably. So an automatic trailing stop loss moves according to how price moves favorably, and then a manual trailing stop loss is a moving stop loss level that's based on mechanical indicators. So here's an example of where you place an idea invalidation level. Okay, so here's our first level. This is moving average. Here we have the chandelier SAR. Here the ATR is parabolic ATR as well. Okay, so here is how to use them. Okay, in this case, we are using moving average as our first example. So here we are going in for a sell entry. You can see I've indicated this level where we want to enter from is a 1.57891 level. Okay, and this is where price crosses the moving average indicator, and that's my entry. Also note this ascending trend line as well, and price is breaking out of it. So a lot of bearish indicators over here. Okay, so price or rather we call this a moving average crossover. So once price crosses over price, then we go in for the entry, price continues moving downwards, and then once price crosses over the moving average again, then our trailing stop loss is triggered. Okay, so it got us out before this happened. So this is the before, this is where you get stopped out. And then this is what happens if you weren't stopped out. Okay. Here we have trendline trailing stop loss. Remember, for a valid trendline, you need at least 3 touches for it to be valid. Here we have 1, 2, 3 over here. Okay, so the same concept on the same chart, we have this trend line with price moving downwards, and once price starts reversing, even though it's reversing, we are not stopped out yet until it hits the trend line, and then we are stopped out. Once again, to prevent us from this eventual upward movement. Okay, so here we have parabolic SAR, trailing stop loss. It's the same concept. We are going in for sell entry once price changes, or rather once our indicator changes. So it's moving downwards, and then once price hits our parabolic SAR indicator, that's a sign for us to be stopped out. So yeah, that's how the parabolic SAR trailing stop loss works. Okay. Here we have chandelier and ATR trailing stop loss. So it's all on the same chart, just to show you guys how you can use the different indicators as your trading stop loss, just to help you guys decide when to stop or get out of the trade. So same thing, same sell entry, same chart. So we go in for the sell over here. Once price moves downwards and it hits our indicator once again, then both of these indicators are triggered and you have gotten out of the trade. So it really minimizes your losses that could have resulted if you had allowed price to continue moving upwards. Okay. So here, how we know this is our sell entry, using these two indicators. Basically, when price overlaps over here, as you can see over here, there's another overlap that takes place, and that's why you get stopped out. Okay. So here is an actual example. Here we have the Kiwi dollar, and we are making use of the moving average indicator. So we go in for the sell entry over here when price so firstly we have this ascending trend line. So it's moving upwards, and then we go in for a sell entry once price starts moving down. So it hits this ascending trend line as our sign that it's gonna break out of the ascending trend line. Going for the sell entry, we continue, and it hits our take profit. Okay, another indicator is that over here, at this green line that I've indicated here, you can see price cross over our indicator. So that's yet another sign that price is gonna continue downwards, or trend is going to change. Okay. Next example, we have once again a trend line. So trend line going upwards, price breaking out of it, then we go in for our sell entry. So going for our sell entry all the way, we're expecting it to move all the way downwards to our take profit. Okay, so the red and the blue lines, as you can see here, the lines that are not indicated as stop loss, sell entry, and take profit, these are the lines that we are showing you are pretty significant because we have an overlap resistance here. So as I mentioned earlier, an overlap is a swing high and a swing low that line up in the same level. So that's our red line. So remember I mentioned that when we have significant areas of resistance, that we want to place our stop loss beyond it. So that's exactly what we did here. And then as for our take profit, over here I have a big swing low over here. So which is why I place my take profit before it instead of below it over here. Okay. So that's the end of our slides. Now we're going to look at some charts and see if we can implement what we've just learned into actual setups. So let me know in the chats if there are any specific setups that you'd like to see. I think you should be able to let me know in the chat or let me know in the Q&A section. Yeah. Okay, I think in the meantime, let's go ahead and just take a look at maybe euro dollar. Okay, if there is any other commodity or currency pair you'd like to see, feel free to let me know in the chat. Okay, so let's get right into it. So we typically like to start on the higher time frames and then work our way down. So here I have on the weekly time frame, we have a pretty bullish, I mean, it looks like price is moving upwards, the general direction. Okay, on our daily as well, we have a ascending trend line. Okay. So both weekly and daily timeframes are giving us pretty bullish trends. Now let's take a look at our 4-hour time frame. Okay, it does look like price is breaking out of the ascending trend line here. Okay, but let's go in with some support and resistance levels. So here's my first resistance and then my second resistance over here. My first support just here. And my second support here. Okay. So now that we have that, let's go in with our Fibonacci levels. So from here to here, I have a retracement. You can see my 50% retracement lines up, and my okay, even though this 50% lines up nicely with my first resistance, it's no longer valid because you can see price has already broken out of this level. So I'm going to look at the other levels. For retracement, we use these 5 levels: 23.6, 30.2, 50%, 61.8, and 70.6. Okay, and I can see that my 78.6 lines up nicely with my second support. So I'll just keep that. Okay, now let's go in with a Fibonacci projection. Okay, I can see that my 61.8 and my 100% line up nicely. Okay, I think that's all the levels that I have. So now I'm going to go in with some indicators. So the indicators that we like to use are Ichimoku and MACD, because just at one glance, it tells you exactly what the signals are. So price is moving below the Ichimoku cloud on our indicator, giving us a bearish signal. MACD is giving us a pretty bullish signal. Slightly bullish over here. Let's take a look at RSI. Okay, we have this bullish signal. If we take a look at our chart, at our price chart versus our RSI, at the highlighted areas, price has remained at the same level at our first support, whereas on our RSI, it has made a higher high, and in fact, price is moving in this ascending trend line on our RSI. Okay, so I'm gonna go ahead and remove this trend line here, because earlier I mentioned that it could be breaking out of the descending trend line, right? But it also could be an ascending trend line. So this is one of those rare occasions where we have 3 touches on the trend line for both, depending on how you adjust it. Okay, so that's why I waited for all of my other indicators as well as my analysis to be completed before I go in and adjust my trend line. Okay, I'm going to remove my Ichimoku as well because it doesn't support our analysis. So you can see that we have quite a lot of bullish pressure here. So we can expect price. Let me just highlight this area as well. Okay, here. So my first support I mentioned is a pretty significant level with all of the swing highs and swing lows and price testing it many times. But I also have the 61.8 Fibonacci retracement. and a 61.8 and let me take a look. Yeah, 61.8 Fibonacci projection. You can see this 3 points over there. So my 61.8 Fibonacci projection lines up nicely with my first support. So I can expect price to reverse off of our first support and within this ascending trend line. Okay, let me know if you guys have any other questions. Okay, if not, I think we can move on to our next chart. Let's go ahead and take a look at gold. Okay, so let's begin by looking at the higher time frames again. We have these 3 swing highs. Price looks like it's moving upwards here. On our daily time frame, price is pretty bullish as well. Okay, this is not a valid trend line, but I think we can all agree price's general trend is upwards. Next, 4 hours time frame. Okay, I have this trend line. Now let's go in with our support and resistance levels. Okay, so I have a support level here. Next, I have a resistance level here. But I'm not going to label this as my first resistance. I'm just going to call it an intermediate resistance because it's really close to where price is at currently. So I just want to keep that in mind. Okay, now. Okay, I try to pull it back as far as I can, but I'm cutting too many candlesticks over here. Okay, next, our second resistance here. Okay. So now let's go in with our Fibonacci levels again. So same thing for a retracement. I use these 5 levels. Okay, and I can see my 38.2 lines up and my 78.6 as well. So I'm just going to keep those 2. Okay, next I'm going in with a Fibonacci projection. So for Fibonacci projection, we use these 3 levels, 100, 78.6, and 61.8. And okay, my 78.6 lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Yeah, I think that's about it. Okay, now let's go in with some indicators again. So price is moving below the Ichimoku cloud. It's also giving us bearish on our MACD. Now let's take a look at RSI. Okay, once again, we have a pretty bullish divergence again. Okay, now let me take a look at stochastic as well. Okay, I'm gonna go ahead and remove our ascending trend line. Okay, here we have a descending trend line, and on our stochastic, we also have a descending trend line here. Okay, so I'm going to move my RSI, and 3 out of the 4 indicators that we've used tell us that it is a descending or it's a bearish momentum. Okay, so in this case, I can expect price to continue moving upwards towards this intermediate resistance, but there will be some resistance over here because of all of the downward pressure from the indicators as well as the descending trend line and also this 38.2 Fibonacci retracement. And as I mentioned earlier, this is a pullback area, pullback resistance. So I can expect price to have some resistance here and maybe reverse off of it and head back towards our first support. Okay. So in this case, our take profit would then be at our first support, entry at our intermediate resistance, and then I'll place my first resistance as my stop loss. And as I mentioned earlier, I want to place it above, maybe slightly above over here, because this area here is a pretty big resistance area with all of the Fibonacci levels lining up nicely. Okay, I think I have time for one more chart. So if you guys have any requests, feel free to let me know. Okay, let's go ahead and take a look at DXY. Just really quickly, this will be our last one for the day. Okay, so same thing, let's take a look at the weekly time frame. Looks like price is moving downwards on our daily as well. Okay, it's moving in this descending trend line on our daily time frame. Okay, no trend line on our 4-hour time frame. So let's just go ahead and add some support and resistance levels. Okay, and then here is my first support. And my second support here. Okay, now let's go in with our Fibonacci levels. Okay, my 78.6 lines up. And let's go in with a projection. Okay, for projection, we use these 3 levels. So I'm just going to check. Okay, and price has surpassed our 61.8, so this is no longer valid even though it lines up with our first support, but our 100% lines up with our first resistance. So I'll be keeping that as well. Okay, so this is a significant area for us to take note of. Okay, I think that's it. So let's take a look at our indicators. Price is moving above the Ichimoku cloud. It's also giving us bullish on our MACD. Okay, RSI isn't really telling us much here. Okay, no. Okay. Let's maybe take a look at stochastic as well. Okay, stochastic is pretty bullish as well. Okay, so we can expect price to continue upwards and be attracted to our first resistance since there is such a major confluence area here. But we can also maybe expect it to reverse off and hit back down to our first support. So, but as of right now, it will be attracted to the first resistance, but it's not likely to pass such a large resistance area. Okay, that's all I have for you guys today. Let me know if you guys have any other questions. If not, I'll see you guys next week. I hope you guys found it helpful. And yeah, I'll see you guys next week and have a great rest of your week. Bye, guys. Bye. Thank you.